Fear seems like a natural emotion, yet so many people say it's the biggest reason investors stay poor. Why does one emotion have so much power over people's financial future?
Because fear isn't trying to make you rich, it's trying to keep you alive. Thousands of years ago, that instinct helped humans escape danger. Today, the same brain reacts to a falling stock market as if it's facing a predator. Your heart races, your palms sweat, and suddenly selling feels safer than staying invested. That's where investing psychology becomes fascinating. The market doesn't just test your knowledge, it tests your emotions. Most people believe successful investing is about finding the perfect stock. In reality, it's often about managing yourself. The greatest gains usually belong to people who can stay calm while everyone else is panicking. That's not luck, that's emotional discipline. Think about it. When headlines scream that billions have been wiped from the market, fear spreads faster than facts. Friends start selling, social media predicts economic collapse, news channels repeat the worst-case scenario all day. Before long, people aren't making decisions based on value. They're reacting to emotion. That's why so many investors buy high when confidence is everywhere and sell low when fear takes over. It's one of the most expensive psychological mistakes in finance. Behavioral finance teaches us something powerful called loss aversion. Losing $100 feels far more painful than gaining $100 feels rewarding. That imbalance pushes people into decisions they'll regret years later. Ironically, the market has rewarded patience far more consistently than panic. History shows that downturns have always been part of investing, yet disciplined investors who stayed focused on the long term have often come out stronger.
So if fear is wired into us, how can ordinary investors stop emotions from controlling their decisions and build lasting wealth instead?
The goal isn't to eliminate fear. That's impossible. The goal is to stop fear from becoming your financial advisor. Start by creating a long-term investing plan before emotions show up. Decide how much you'll invest, how often you'll invest, and why you're investing. Then let that plan guide you when markets become noisy. Remember that temporary price drops don't automatically mean permanent losses. Sometimes there's simply the cost of participating in wealth creation. Here's a thought that changed the way I see investing. The stock market transfers money from the impatient to the patient. Every downturn eventually asks the same question. Will you react or will you think? The people who answer with patience usually give their money the chance to compound. Financial freedom isn't built by avoiding uncertainty. It's built by making wise decisions despite uncertainty. Fear will always knock on your door, but you don't have to invite it to sit at your investment table.
What a powerful conversation. Fear will always be part of investing, but it doesn't have to control your future. The investors who build lasting wealth aren't fearless. They've simply learned to make decisions based on discipline instead of emotion. If today's discussion gave you a new perspective on investing psychology and building wealth, make sure you subscribe, like this episode, and share it with someone who needs to hear it. We'd also love to know your thoughts, so leave a comment below. What's the biggest fear you've had to overcome as an investor? Thanks for spending your time with us, and until next time, keep learning, keep growing, and remember, wealth is built one smart decision at a time. We'll see you in the next episode.